I want to start today with two pictures. Same couple, same savings, same home, same social security record, same everything, up until one specific birthday. In the first picture, they turn 65, and the day comes and goes like any other Tuesday. They get a few phone calls, maybe a card in the mail. Nothing changes financially. They file for Medicare because they know that part. But 7 other things that became available to them on that exact birthday, things that could have permanently changed how much tax they pay, how much their retirement savings grow, and how much income they keep, pass by completely unnoticed. Nobody called, nobody sent a letter. The government does not announce these things. In the second picture, the same couple knows what to look for. And over the next decade, that knowledge is worth tens of thousands of dollars in real, keepable income. Today I'm going to walk you through all 7, and by the end of this video, you will know exactly which picture your 65th birthday looks like. And if that birthday has already passed, you will know what to go back and claim. I'm Anderson. I spent 5 years as a financial advisor in New York, helping families navigate retirement planning, Social Security decisions, Medicare strategy, and the tax side of income in retirement. Now let's walk through all 7. The first move involves your federal tax return, and it is one of the most straightforward and most commonly missed benefits in the entire tax code. When you turn 65, your standard deduction increases, and in 2026, it increases significantly. Here is what the full stack looks like. Every American taxpayer receives a standard deduction of $32,200 in 2026. That comes off your taxable income before you pay a single dollar in federal tax. Then, at 65, a first age-based addition of $1,650 per person is added. For a married couple, that is $3,300. Then a second age-based addition, the new senior deduction created by the One Big Beautiful Bill, which applies through 2028 ARIS, adds another $6,000 per person, or $12,000 for a couple. Stack all 3 together, and a married couple filing jointly can shield $47,500 of their income from federal tax entirely. Let me put real numbers on that. A couple with $70,000 of ordinary income, pension, IRA withdrawals, Social Security, can reduce their taxable income to roughly $22,500, with most of that falling in the 10 and 12% brackets. That is a very different tax bill than most people expect to pay. And here is something most tax preparers do not explain clearly. The $6,000 per person addition does not require you to take the standard deduction. If you itemize, because you have a large mortgage or significant medical expenses, you can still claim that $6,000 on top of your itemized total. There is a phase-out that begins at $75,000 of income for single filers, and $150,000 for married couples filing jointly. So if your income is near those thresholds, the amount of your deduction begins to shrink. Managing that boundary, keeping your taxable income below the phase-out line, becomes an important annual planning task. The second move involves something called a health savings account, or HSA, and it is one of the most powerful and most misunderstood accounts in all of retirement planning. Before age 65, an HSA has one job: paying medical bills. The money goes in pre-tax, grows tax-free, and comes out tax-free when used for qualified medical expenses. That is already excellent, but here is what changes at 65 and what almost nobody tells you. After your 65th birthday, you can use your HSA funds for any expense at all, not just medical, and pay ordinary income tax on the withdrawal, exactly the same as you would with a traditional IRA. In other words, at 65, your HSA becomes a second IRA that happens to also have the medical tax-free withdrawal benefit still fully available. Now there is a specific strategy I want to share that very few people ever use. If you paid medical bills out of pocket over the years and chose not to reimburse yourself from your HSA immediately, you have not lost those receipts. The IRS does not require you to claim HSA reimbursements in the same year as the expense. You can accumulate receipts for medical costs you paid years ago and submit them for reimbursement at any time, as long as the expense occurred after the HSA was opened. That means a $4,000 dentist bill you paid out of pocket in 2015 could be reimbursed today, tax-free, with money that has been growing inside the HSA for the past 10 years. The reimbursed amount reflects the current value, not the original cost. For anyone who has an HSA and has been paying medical bills out of pocket and keeping receipts, this is one of the most valuable financial strategies available in retirement and one of the least discussed. 2 important timing notes. Once you enroll in Medicare, you can no longer contribute to an HSA, and Medicare Part A can backdate enrollment by up to 6 months, which means you should stop contributing at least 6 months before you apply for Medicare to avoid a penalty. And there is a one-time opportunity to move money from a traditional IRA directly into an HSA up to that year's contribution limit, converting what would have been a taxable IRA withdrawal into a tax-free HSA withdrawal if the funds are used for medical costs. The third move is one that most people never pursue, simply because no government agency ever announces it. When you turn 65, a range of state-level tax benefits typically become available to you. The most common is property tax relief, which comes in 3 forms depending on your state. An exemption that reduces the assessed value of your home before the tax rate is applied. A freeze that locks your assessment in place, so your bill cannot rise even as neighboring property values increase, or a deferral that lets you postpone the tax until your home is eventually sold. Many states also exempt a portion or all of retirement income from state income tax, and some do not tax Social Security benefits at all. The critical detail is this: none of these benefits come to you automatically. Your state knows how old you are, your county assessor knows your name and address, but they will not send you a letter explaining your new eligibility. They will continue to bill you at the full rate until you initiate the request. In most states, the application window for property tax relief opens in January and closes around April or May. Missing that window means losing the entire year with no opportunity to recover it. The action is simple. Call your county assessor's office and ask what senior property tax exemptions, freezes, or credits you qualify for, and what the deadline is to apply. One phone call can produce savings that repeat every year for as long as you own your home. The fourth move involves Social Security, and it is specifically about a mistake that a significant number of people make on their 65th birthday, not because they plan to, but because 65 feels like the natural moment to file. For decades, 65 was the full retirement age for Social Security. That changed in the year 2000, and the adjustment has been phasing in ever since. Today, full retirement age, the age at which you receive your complete, unreduced Social Security benefit, is 67 for anyone born in 1960 or later. 65 is no longer full retirement age. If you file at 65 with a full retirement age of 67, you are claiming 2 years early, which permanently reduces your benefit by 13.3%. On a $2,500 full retirement age benefit, that is roughly $330 less per month every month for the rest of your life. Over 20 years of retirement, that equals approximately $80,000. And the effect compounds through the survivor benefit. The surviving spouse keeps the higher of the 2 payments, so a lower filing amount locks in a smaller survivor income for decades after the higher earner is gone. I want to be completely clear. Filing at 65 is sometimes the right decision. Health, job loss, financial need, all of these are legitimate reasons to claim early. But filing at 65, because you assume it is the correct age, without knowing what it costs you, is the mistake. The birthday feels meaningful. The financial decision should be made on numbers, not on the feeling that you have arrived. The fifth move is one of the most financially powerful available in the years just after retirement, and it has a window that eventually closes. Between the day your paycheck stops and the day your required minimum distributions from retirement accounts begin, many people experience a period of relatively low taxable income, perhaps the lowest they will see for the rest of their lives. For anyone born in 1960 or later, Required minimum distributions do not begin until age 75. That means there can be a full decade, or close to it, where your income is lower than it has been in years, and lower than it will be again, once RMDs force withdrawals from your traditional IRA or 401k. This window is the ideal time to do what is called a Roth conversion. You take a portion of your traditional IRA, the pre-tax money, and move it into a Roth IRA, paying income tax on the conversion amount at today's lower rate. The money then grows tax-free inside the Roth for the rest of your life, and Roth accounts have no required minimum distributions. The strategy is to convert deliberately every year, filling your lower tax brackets without pushing into higher ones, and to stop before you cross any lines that trigger negative consequences. The two lines to watch carefully are the $6,000 per person senior deduction phase-out. A large conversion can push your income above the $75,000 or $150,000 threshold and reduce that deduction. And the IRMAA surcharge on Medicare premiums, which is calculated using your income from 2 years ago. A conversion at 63 becomes visible in your Medicare premium at 65. These interactions require coordination, but the long-term benefit of a smaller traditional IRA, and therefore smaller required minimum distributions, compounds significantly over time. The sixth move is one that most people back into after they have already started withdrawing retirement income, and that is the order in which they draw from their accounts. Getting this order right in advance costs nothing and protects your portfolio in ways that even strong investment returns cannot fully compensate for. The risk it addresses is called sequence of returns risk. The reality that if the market falls significantly in the first few years after you retire, you are forced to sell investments at depressed prices to fund your withdrawals, and those sold shares never get the opportunity to recover. Early losses in retirement have a disproportionate and lasting effect on how long your money lasts. The conventional starting point for withdrawal order is to use your taxable brokerage account first, your traditional IRA or 401k second, and your Roth last. This preserves the tax advantage growth as long as possible. But the smarter version blends withdrawals, pulling just enough from your traditional IRA each year to fill your lower tax brackets, while using your taxable accounts and Roth for the remainder. This keeps your traditional IRA from growing unchecked into a massive required minimum distribution problem in your 70s. The decision about withdrawal order is worth making on paper, deliberately, before the first check is written, not discovered after 2 or 3 years of accidental tax inefficiency. The seventh move is less a single action and more a discipline, and it is one that I recommend to every person who has reached 65, regardless of how thoroughly they have addressed the other 6. Once a year, ideally around your birthday, sit down with all of your accounts, your tax return from the prior year, and your Social Security statement, and do a complete financial review. Not because things are likely to have gone wrong, but because the rules change constantly, your circumstances change, and the intersection of those two things creates opportunities that expire if you do not catch them. The senior deduction that exists today phases out in 2028 unless Congress extends it. IRMAA thresholds adjust annually. State property tax deadlines shift. Medicare plan benefits change every year at open enrollment. Social Security cost of living adjustments affect your taxable income calculation. None of these are set and forget. The annual review is the habit that makes sure the 7 moves we covered today stay working for you, not against you, year after year. If you are not yet 65, share this video with someone who is approaching that birthday. And if you are already past 65, go back through those 7 moves and ask yourself honestly which ones you have used and which ones have been sitting there unclaimed. The before picture and the after picture I described at the beginning of this video are both real. The only thing that separates them is information. Subscribe if you haven't, hit the bell, and I will see you in the next one.